So thank you very much for coming to listen. And it was interesting to follow Keith and Ron. And when they talk about Keith talks about the size of the deposit, nothing that they've seen in Africa before, and Ron talks about the best undeveloped gold deposit out there. So it's a fairly difficult sort of act to follow. But as I go through it, and we talk about specifically the diamonds which we're recovering, what we've seen recently in recoveries, I think it's sort of just one of those things that the Lundin Group has been able to do, is to bring in things that the world has not seen before, things that are way in excess of what we would normally look at now as being economic. So just quickly for 2015, we started off the year, revenue guidance has not changed from $230 to $240 million worth of diamonds sold. We're looking at selling between 400 to 420,000 carats through this year. The way we're going to sell that is exactly the same as what we had done previously. It does look like, based on the timing and access to the South Lobe, we will only do 2 exceptional stone tenders. It's not going to change the amount of money that we actually plan on making this year through the sale of those 400,000 carats. We started off about 18 months ago with our plant optimization project. We were talking about $55 million worth of capital expenditure. We have about $20 million of that to go in 2015. Actually, $10 million of that was spent in the first quarter of the year, so we've got about another $10 million to go. If we look at our overall operating costs, our guidance is $33 to $36 per tonne processed. If we look at our Q1 results, that came in about 28. We do have additional material that we have to move, and I'll show you a slide later where you can actually just see the volume of waste which have already started moving. So we do expect the overall costs to increase, but still come in at the bottom range of the guidance which we've put out there. And then of course, if we look at our overall sustaining capital, when we built the mine, and our mill it's a fairly large beast, but the guys that do the mill relining said that, no, not to worry, we're all strong, burly men. We'll just manhandle the liners in. And now that we've actually transitioned over to metal liners, specifically on the discharge grate, they're now having to manhandle 20-ton liners. So we are installing a mill reline machine. About $3 million of the sustaining capital you see up there will be spent this year, with another $2 million being spent next year, just to make sure. And it's more from a safety perspective. We want to be able to get things in, and the quicker we can get them in, and the safer we can get them in, the sooner we can actually get access to more South Lobe material. In terms of the overall exploration budget, and I think it's odd because we had our first quarter results conference call last week, Wednesday, and half of the questions that people actually asked were around the exploration budget, which is kind of different because most of the time I expect to get questions on when are we selling large diamonds, or what large diamonds do we have in the vault. So I think as we move forward and we start to get closer to being able to produce exploration results, the information which we're going to be putting out, it's really going to be sort of a lot more exciting than what it is now, because it looks at what are we going to do with our cash and how are we actually going to continue to advance the project. On Matai, so we've been sort of around Matai for quite a while. Actually, I think every time I've been here we've had a short discussion on Matai. But we've now looked at Matai in every possible way. Small scale, large scale, contractors, people bringing in process plants, it just doesn't make money. So with our decision to actually divest from Matai, when we put out that press release, the very first phone call I got was from an analyst in London. And what he said to me was, we're quite relieved. So it is a common practice for mining companies, because they've got money, because they've got cash flow, even if they only have a project which is marginal, they will take money that they've actually made and put it into something which is actually not going to generate value for shareholders. And if we look at how we've actually done our due diligence on pretty much everything which is out there, we want to take that forward. We want to make sure that the cash flow which we're generating is used to drive more cash flow, not just to have another project. And that's really sort of where the decision came from, to divest from Matai. And then I'll talk a little bit more about the exploration. There's a couple of slides, so we'll jump forward because somebody's going to shout at me because I'm talking too much. So very, very briefly, it really, the slide here really shows the dark bars there is the revenue growth which we've seen. 6 months of production in 2012, $42 million, 181 in 2013, and then 265 in 2014. And on the next slide, we'll actually just go 2 slides down, sorry. We'll go through sort of where the materials come from. So this is all North Lobe material, actually back where we were for the last sort of 4 or 5 months. Most of it north and centre. And then obviously the big one is the access to the south lobe. And the only reason why this curve actually drops down in terms of our cash flow margin is because we had the capital program. So we were spending more money on ensuring that we could actually maintain that as we go forward and mine more material from the south lobe. I've most only pointed this out plenty of times. Everybody knows where our projects are, right up here in the central Kalahari. And the two prospecting licenses which we have, Block A is about 30 kilometers away from where our mine is, Block E sitting at about 12 kilometers. So really within striking distance. If we were not going to find, or we don't find anything where we can actually build a new mine, we do have the opportunities of finding something which is maybe less economic, but can still be processed through the operation which we have. So I've left the slide in, and I'm sure that people that come to the retail presentations regularly go, when are you going to change that slide? Oddly enough, the resource hasn't changed. But the reason why we've left it is, as we've gone into the plant optimization project, the reason for doing it is this purple section over here, it's fresh kimberlite. It's pyroclastic magmatic kimberlite. So it actually contains the building blocks that actually make up the Earth's mantle. So a very large quantity of magnetic or metallic minerals. So hematites, ilmenites, sort of magnetite. So when you process it through the plant that we've got now, DMS yield which you get is excessive. Through this nice weathered material, because a lot of those minerals were altered, we would get maybe 1% yield. When we get into the purple stuff, it gets up to about 15% yield. And it actually just means that the plant cannot process the volume of material which we've become accustomed to. So while the plant optimization has been completed, we've obviously been focusing mining in this area. And that's really where the results for the revenue generated from the first quarter come from. The $277 a carat is predominantly diamonds which have been sourced from these areas over here, as well as the stockpile. So, most important thing for us, and what everybody actually knows, is this is where a lot of the large stones, especially the high quality large stones, come from. So about 4 weeks ago, we announced the recovery of actually now one of the top 30 largest diamonds ever recovered, and it's that one at 342 carats. It is a very heavy stone. It is a beautiful, clear, D-color stone. I'm sure somebody wants to ask me how much it's worth. I actually don't know. But we do believe that it will end up being the most valuable stone which we've sold to date. The current record is held by a 176 carat stone, sold for $12.7 million, or $72,000 a carat. So that's obviously interesting. But the reason why we keep this slide in is there are still people that continue to say to me, your large stones are going to stop. The large stones are horizontally layered and you're going to run out. And that's a very important point. At the deepest section that we've currently mined, in the hardest material we've currently processed, we recovered the largest, most valuable diamond we've recovered so far. So we've only put 35 of the points in there. It's fairly difficult. When we put all 63, actually 65 plus 100 carat stones in there, it becomes a little bit busy. So it's really identifying the really high value ones where we got a decent price at the auction. So when we actually built the mine, the resource statement which we had was these bars over here. $276 a carat for diamonds recovered from the north, the same for the center, and only $231 for diamonds from the south. And as we went through the processing, we opened up material from north, center, and south, really through 2013. When we updated our resource statement, this is what we currently have. And it's a very bold person who actually will predict when you can recover any stone which is larger than 10.8. So it's normally just a percentage. And the resource statement which we have now talks to 3.8% of our diamonds being larger than 10.8 carats. And 10.8 carats, it's mostly about an 8 millimeter stone. But because we've now got such a coarse distribution, we've actually added in these lines. That's what we actually sold for. So in 2012, mostly mining from this area over here, we sold for $253 a carat. Oddly enough, from 276 down to 50 or 253, it's still within 10% of what we expected to get. And for a diamond resource, plus or minus 10% is pretty close. But in 2013, as we started to mine material from the center and the south lobe, you could see the coarseness of the material change. That's why we have 411. And as Lucas mentioned, over $600, actually $644 a carat for the diamonds which we mined and sold last year. And it's really based on the recovery of large stones. That's why it's so important for us to finish the plant optimization, and get back into the South Lobe, because we know that is where the larger, especially the better quality stones come from. So, too much data. I just wanted to point out sort of our waste stripping going from 2 up to over 3 million tonnes in the first quarter. So we are moving a lot more ground. We do have bigger trucks, etc. on site. And then these numbers, so the 277, that's what we sold it for, or sold our diamonds for in the first quarter of this year. Actually not too far off, 305 from the first quarter of 2014. And the margin's sitting around about the same. And it's really when we actually have sufficient large stones to sell that we start to see that number escalate quite significantly. So when we look at our sales, 106,000 carats sold in the first quarter. That's the 277. And I do like to tell stories. So last week, Wednesday, 6 a.m., we're in the office and we have our results conference call. 7 o'clock, we close our first tender of the second quarter. 10 o'clock, we actually had our AGM. Nothing like going into the AGM, having information which you know you cannot actually tell the shareholders. But at that sale, we sold, the sale last week, Wednesday, we sold 57,000 carats. And it was material that had been mined, some of it from the South Lobe as we were commissioning the process plant, some from the centre, but from the stockpile. And you would have most probably heard, if you do a lot of reading in the media, the overall impression of what's happening in the diamond sector is you'll hear lack of liquidity, De Beers aren't getting their pricing, and it's all negative. The sale that we had last week, Wednesday, is the highest average dollar per carat sale we have had in any regular tender so far. So in 22 tenders, last week, Wednesday, was the record. So when we hear that the market is all depressed and it's all doom and gloom, it's primarily based on what is happening to your 2 largest producers, Alrosa and De Beers. They produce 80% of the world's diamonds, so generally they are the market. But oddly enough, I made a comment last week, Wednesday, that if De Beers are struggling, people don't want to pay them the prices that they're demanding. People still have money. When they have money and they're looking for goods, where are they going to come? Cara wants to stand in the front of the queue. And we definitely saw that last week, Wednesday. Even though we had a sort of a fairly large component of single stones, which pushed the average up, the numbers which we got in terms of above our reserve price were, in some cases, quite staggering, which also indicates that if people are not willing to pay De Beers that value for the diamonds, even if De Beers starts to drop their prices, they've actually got a long way to go to get down to where we know that at least our clients are making 5 to 10% margin. So we're actually very comfortable if we look at the sales which we've got going forward. 153 diamonds recovered, larger than our 10.8 cutoff during the first quarter. If we did 815 through 2014, we would have expected that to be closer to the 200 mark. But again, it's specifically because we're not mining in an area which has historically produced the same volume of large stones which we would generally like to see. But we've actually already seen that start to improve, and I'm going to touch on the XRT machines of how well that's gone further on. So obviously the question, if I don't mention it, somebody should ask it, is when are we going to have our first exceptional stone tender? So next week, Tuesday, there will be an announcement of what the exact dates are. We currently have a fairly nice parcel of diamonds. We've obviously got our 342 carats, so that will be the primary stone, but in the mix there's 196, 142, 143, 126. So 5 stones larger than 100. And actually my favorite stone, which is about 62 carats. And you would swear it was a piece of glass. It's just beautiful and clean. And what we've seen, as we've started to collect the stones for this first exceptional stone tender, the date, which will close most probably the second week in July, we've actually seen much cleaner stones than anything we've sold before. The stones are whiter. And it's a sort of characteristic which we've seen in the back end of last year when we processed more material from the South Lobe. The diamonds are just better quality. They're cleaner, they're whiter. So we're quite looking forward to the results from that tender. But sort of when the date is announced, we've been fairly cryptic in how we've approached it. It is the Las Vegas Diamond and Jewelry Show next weekend. So if we tell people there's going to be a tender, it means sell your diamonds, hoard your money, Lucara is having a tender. We hope that they'll actually see it that way as well. So looking at the plant optimization project, the reasons why we're doing it is specifically to be able to handle the varying ore characteristics. Most of it is now finished. Actually, I'm waiting for one pump. When the pump is it's a transfer pump from the DMS into the recovery. The XRT machines, the tertiary crusher, all of those have actually now been integrated into the process plant. We've actually had some fairly decent recoveries from when we actually switched on the machines. And we have 5 of the XRT machines now treating anywhere up to 350 tons an hour, obviously in different size fractions and different throughputs. But you can actually see the numbers here. 3 stones between 50 and 100, 4 stones over 100, of which 3 of them were recovered by the XRT machines, and 90 is the number between 20 and 50. That's actually not bad stats for about 3 weeks of production, especially while you're going through a commissioning process. There's always going to be learnings, but the machines have pretty much integrated themselves into the process plant. So we're very happy with the way those are currently operating. Tertiary crusher, that was the last piece of major equipment to be installed. We've done our dry runs on it. It's gone from 20 mils down to 15. The next step is down to 30 mil. So when we look at the results which we've gotten for the sale of diamonds so far, 644 is a really high average dollar per carat. What we do expect to see is that number to drop. Don't panic when I say that. The reason for that number dropping is with the introduction of the tertiary crusher, we know that we've been throwing away sort of smaller diamonds. It's just because we've been targeting the larger ones. And if we look at last year, if we put $5 million worth of diamonds on the dump, we recovered $136 million of diamonds sold at the exceptional stone tenders. The math is fairly easy to do, but it's $5 million that we would like to recover. But it's also $5 million worth of a much larger volume, very, very small diamonds. So when you now look at your weighted average, we would expect that average from 644 to start to drop. But it's also based on a much higher dollar per ton. So all that it means is, if that number's dropping, have a look at the number of carats sold. It's still more money in the bank. So as I mentioned, the last piece of equipment is just one pump in the recovery that still needs to be completed. We expect that pump to be on site within the next week, so by next weekend, project is done, and then it's just the cleanup and just making sure that the learnings which they have to go through again, because the flow sheet has changed, is in place. And then of course the south lobe is literally, I can't say string of pearls, so it'll be our oyster. So a couple of pictures, don't know what the color is like. So this is what this is our XRT building. Obviously the latest and greatest in terms of diamond processing. These are the machines. That single unit, once the material has been prepped, and by prepped I mean screened and sized into specific size fractions. The ones on the ultra coarse, so targeting diamonds about that big, up to 1,000, 1,200 carats. That machine does over 140 tons an hour. Coarse machine, also, they're all the same, they all look the same. Does between 80 and 100 tons an hour on the middles machine, between 30 and 40. So from 100 tons an hour, the single machine processing, let's call it 2,400 tons a day, will produce most probably 3 glasses of concentrate. That's how efficient the machines are. And it's the reason why they're that efficient is technology which De Beers and everybody, even people building new plants now, use, it's for X-ray fluorescence. You're looking for the impurities in the diamond, so the nitrogen which actually causes the diamond to fluoresce. What these machines do is they look for carbon, and 99.9% of your diamond is carbon. So the actual discrimination technology being used is far superior to anything that has been used before. But of course, we're all risk managers. I think any CEO who says he's not a risk manager needs to write that on his business card. So we have been sort of fairly risk averse in how we've approached it. 60% of the material that gets processed through these machines gets recycled through the process plant, and 60% of whatever's supposed to go out to tailings gets processed through a secondary audit machine. Oddly enough, all the tailings we're stockpiling separately. Let's just make sure that we understand the technology, make sure we're maximizing revenue recovery. That's the tertiary crusher, obviously our sort of diamond liberator. And oddly enough, the circuit was commissioned sort of a good 4 months ago. It's the secondary gyratory circuit. It's there to assist comminution in the mill. We actually haven't used it yet. But again, we want to make sure that when we do get into harder, more difficult to process material, we're not going to have to go back and say, oh, we've got another sort of 6 months delay because we need to now install something else. So we've made sure that we've actually taken care of everything now. And if we look at our sustaining capital going forward, we're looking at between $5 and $6 million a year. For a plant of this size, it's actually a very small number. So we've got a very simple plant. We've got all the technology in there that will process pretty much anything you could find in the next 3 slides from the exploration, but it allows us a lot more flexibility in what we can do going forward. So, there I am. Next two slides shouldn't be in there, but I'll quickly run through them. So this is Mswali, the new exciting area. And we've done ground geophysics on both of the 2 exploration licenses we've got. And a bit of history on this. The mine that we're currently extracting ground from, AK6 kimberlite. Initial exploration work was done in the late 60s, early 70s. De Beers went out there and they just mapped everything. They found hundreds of kimberlites. They would do 1 or 2 sort of drill holes into the kimberlites, identify whether they were diminiferous, and then they found the AK1 kimberlite. It's 131 hectares. They mined that kimberlite for the first 27 years without having to do 1 ton of waste stripping. It is enormous. So if you're mining something which is 131 hectares in size, who cares about anything which is actually less than 10, less than 20? So all of these exploration assets which De Beers has identified, where there was a kimberlite, where there were diamonds, they sat on for 35, 40 years. And then the government of Botswana said, use it or lose it. So De Beers gave them back. And a lot of people picked them up in late 2004, 2005, decided what they were going to do, went out to raise money in 2008. We don't really have to talk about that. So there's still no work that's been done on a whole stack of exploration targets within the Arab area, within 30 kilometers of where our mine is, for almost 43 years. So the 2 that we've actually got, that sort of Block A covers the BK2 kimberlite, Block E, 4 kimberlites, AK 11, 12, 13, and 14. BK2 and 11 and 12 are identified as diamondiferous. We know that they contain diamonds. Oddly enough, BK2 is our Mineral Resource VP's favorite target. While they were doing microdumps, so they're looking for diamonds half a millimeter in size, half a millimeter in size. They break a 1.6 carat stone. The probability of finding that is exceptionally low. It's like looking for hen's teeth. So the size distribution which the BK2 kimberlite could actually generate might actually be similar to what we have. We don't know what the grade is, so let's get in there. And we're not going to go and... De Beers spent $49 million doing exploration work on AK6. For these ones, we're not going to spend that much money. Our exploration budget for this year is $3 million, over and above the purchase of the bulk sample plant. But what we're doing is, I guess, sort of different to the way everybody else would do it. Let's get in, let's get a sample of diamonds, check the value of the diamonds. It's normally the last thing that De Beers does. But if you don't understand the value, you're going to spend $25 million before you get to the value, the value of the diamonds, and it's money gone. So let's see what the value is. Do a little bit sort of backwards, and across these 2, the BK2, AK11, and AK12. Those are our first 5,000 ton samples. So bulk sample, they're doing civils on site. We expect that bulk sample plant to be fully constructed by August. We'll be commissioning. We're waiting for permits to extract. And just to create a little bit more excitement, BK13, we went and we did sort of ground geophysics, and it was identified as a dike feature. And a dike could be that wide, it could be a meter wide. But what they've identified is actually a magnetic globe. So it could be another kimberlite pump. So as soon as we do get our permits to extract, drills are going out there. That'll most probably be the first one that we pump a hole into. Let's see if there are other things, prospective things which we can actually use to grow our asset portfolio. So really in conclusion, focus in the short term is let's make sure that the plant optimization and the integration into our current plant is actually working well. It gives us access to additional South Lobe material, which we actually know is what drives the revenue throughout the year. Develop our resource. Let's go out. Let's find something else. Let's grow the resource base. Oddly enough, the information which we'll get from the processing of the South Lobe in the last 6 months of the year is going to give us a good indication of whether underground mining is a true possibility when we can compare the revenue to costs at depth for the South Lobe. So Karowe, $230, $240 million of revenue from the sale of 420,000 carats. Cost guidance still stays the same, although we are trending towards the bottom one. Let's get the government to give us a thumbs up, sell Matai, put more focus into what we're actually doing in Botswana, and really move those exploration licenses forward. Thank you very much.
Tack så mycket William. Alltid lika intressant att höra om diamanterna, och jag tror att alla känner sig säkra på att under andra halvåret här så kommer det spruta ut stora och exceptionella stenar när vi är tillbaka i South Lobe i Karowe. Så att, finns det några frågor till William här? Där borta ser jag en fråga. Dina kommer med mikrofon.
I would like you to deliberate on the supply side of diamonds, as there are two other supplies, like artificial diamonds and also seed harvested diamonds, which De Beers have a fleet of ships that are outside the coast of Namibia, and they are said to be of better, so to say, yield and clarity. I don't know, but that is what I've been told. So what would happen with the price? That is very high, so to say.
Well, let's start with the alluvial diamonds. I've been fortunate enough to be able to throw out one of the ships. The alluvial diamonds and the qualities that they produce is spectacular. Alluvial diamonds will run on average $1,000 a carat, even for the small ones. But if they produce 350, 400,000 carats a year, it's a lot. So around about the volume of diamonds which we produce from Garowe is generally what you get from marine operations. If they are commissioning another ship, which will make it fine that they actually have the West Coast. It is a shockingly expensive operation. The guys that work out there are working at 28 days on, 28 days off. They mine normally at the depth about 120 to 140 meters. It is not a cheap process by any stretch of the imagination. So I wouldn't see anybody rushing out there and suddenly saying we should buy ships and go out there. It's a very small volume. When we look at the volumes, however, for synthetics, that is slowly starting to increase. But if we look at it in context, mined diamonds last year total around about 130, 180 billion carats. The total number of carats produced by synthetics is in the order of 60,000. That's in the mined volume. So you can do the math on sort of what you would expect to get out of 130 million carats. So it's very different to, say, the natural pearl market. If you went back sort of 80 years and you looked at how many natural pearls would be produced, it was a couple of cupfuls. So the ability to actually exceed the volume of diamonds which were actually pulled off, the volume of natural pearls was very, very quick. You just went out and exceeded a whole bunch of oysters and off you went. So the probability of synthetics actually being able to get to the same volumes that the mines produce, also with the same cost structure, is not something we see, definitely not in my lifetime. It is a growing interest. So De Beers, they've done all the research, they went out and they spoke to 20,000 women, and they said to them, you can have this diamond, 1 carat, it's yours. It was laid in the factory yesterday, it's $10,000. Or you can have this one. It took Mother Nature 19 million years to create. Same diamond, $20,000. 95% of the women would say they would take the natural diamond. And it comes down to the marketing that De Beers has done. The relationship that De Beers has created between a diamond and what it symbolizes to a married couple, and 60% of diamonds still end up in engagement rings. It's still the primary market for consumption. But all those factors actually have to be overcome for synthetics to become a real threat to the natural diamond market. So that answer?
Yes. Yes.
Tack så mycket. Finns det någon mer fråga till William här? Det verkar inte göra. Då skulle vi allihopa vilja tacka er så mycket för att ni än en gång